Silver is entering a structural stress phase. Why a repricing risk is building. 1. Silver's current market context. Silver enters the final stretch of 2025 in a markedly different position than it occupied just a few years ago. No longer trading as a neglected byproduct of the precious metals complex, silver has moved into a higher price regime characterized by volatility, heightened attention, and increasingly fragile market structure. While short-term price fluctuations remain pronounced, the broader context suggests that silver is no longer behaving like a purely cyclical commodity. Instead, it is beginning to reflect deeper structural forces at work. At elevated price levels, daily or even weekly declines carry less informational weight than they once did. A $1 drop in silver today does not have the same implications it would have carried when silver traded in the teens or low 20s. Price moves must now be interpreted relative to scale, liquidity, and positioning. What appears dramatic on a chart may, in fact, be little more than noise within a broader repricing process. This context matters because silver occupies a unique dual role in the global economy. On one hand, it functions as a monetary metal, historically associated with store-of-value characteristics, inflation hedging, and currency debasement narratives. On the other, it is an indispensable industrial input, embedded deeply within electronics, energy systems, medical devices, and emerging technologies. Few assets straddle these two worlds as directly or as vulnerably as silver does. That duality creates tension. Monetary demand responds to macroeconomic conditions, interest rates, currency confidence, and geopolitical stress. Industrial demand responds to production cycles, technological shifts, and long-term infrastructure investment. When both vectors begin to rise simultaneously, the market is forced to reconcile competing claims on a finite physical supply. Historically, this reconciliation has not been smooth. Silver's current context is also shaped by its relatively small market size. Compared to gold, global silver inventories are thin, annual mine supply is modest, and available above-ground stocks are far less concentrated in institutional vaults. This makes silver inherently more sensitive to incremental changes in demand or supply behavior. A modest shift in procurement strategy by a single large industrial user or a handful of wealthy buyers can have outsized effects. At the same time, silver remains heavily financialized. Price discovery continues to occur primarily through derivatives markets rather than through physical exchange. This disconnect between where price is set and where metal is actually sourced introduces fragility, especially during periods when physical availability tightens. The market can function smoothly until it doesn't. Importantly, silver's recent strength cannot be understood in isolation. It is occurring alongside broader questions about monetary credibility, fiscal sustainability, and the limits of financial engineering. In such environments, assets that sit at the intersection of finance and reality, things that must ultimately be delivered, consumed, or used, tend to attract renewed attention. Silver today is not simply reacting to headlines or technical levels. It is responding to an evolving landscape in which long-standing assumptions about liquidity, availability, and substitution are being quietly tested. Whether or not the market fully acknowledges this shift yet, the context has changed. And markets that change context rarely revert smoothly. 2. Spot versus futures pricing, early warning signals. One of the most important and most misunderstood signals in the silver market lies in the relationship between spot prices and futures prices. Under normal conditions, futures contracts trade at a premium to spot. This structure, known as contango, reflects the cost of carry, storage, insurance, financing, and time. In a well-supplied, well-functioning market, contango is not only expected, it is essential. Backwardation, by contrast, is an abnormal condition. It occurs when spot prices rise above futures prices, signaling that immediate delivery is more valuable than future delivery. In commodities markets, backwardation often indicates supply tightness, logistical constraints, or rising concern about availability. In precious metals, particularly silver, it is rarer and more telling. Silver's market structure has recently hovered uncomfortably close to this condition. Spot and near-dated futures prices have at times converged, flattened, or briefly inverted. Even when outright backwardation is not sustained, the mere erosion of contango is meaningful. It suggests that the market is no longer confident that future supply will be as readily available as pricing models assume. This matters because futures markets are built on trust. Trust that metal can be delivered when required, trust that hedges can be rolled, and trust that contracts reflect reality. When that trust begins to fray, pricing relationships adjust before headlines do. In silver, this tension is amplified by the metal's consumption profile. Unlike gold, which is largely hoarded and recycled, silver is consumed. Once used in electronics or industrial processes, much of it is uneconomical to recover. This means that future supply depends heavily on continued mining output and recycling efficiency, both of which face constraints. When spot prices press against futures prices, it implies that buyers are increasingly willing to pay up for immediate access rather than accept the promise of future delivery. This behavior is inconsistent with narratives of abundant supply. It reflects urgency. Importantly, these pricing dynamics do not emerge in isolation. They often coincide with rising lease rates, declining visible inventories, and increased direct procurement by end users. The futures curve becomes a diagnostic tool, revealing stress points beneath the surface. Critics often argue that backwardation signals in precious metals are fleeting or irrelevant. Yet history suggests otherwise. In multiple commodity markets, from energy to base metals, sustained pressure on the futures curve has preceded periods of sharp repricing or structural adjustment. Silver's relatively thin physical market makes it particularly vulnerable to such inflections. It is also important to understand that futures pricing is not merely a reflection of supply and demand. It is influenced by positioning, leverage, and market-making incentives. Large institutions can suppress or distort signals for extended periods. However, they cannot eliminate the underlying need for metal when delivery obligations arise. When pricing relationships compress, flip, or behave erratically, it is often because the market is negotiating between paper abundance and physical constraint. These negotiations do not resolve quietly. They resolve through price. Silver's spot versus futures behavior should therefore be viewed not as a technical curiosity, but as an early warning system. It is the market's way of signaling that assumptions baked into pricing models may no longer hold. 3. Paper silver versus physical supply. At the heart of silver's structural tension lies a stark imbalance: the scale of paper-silver trading versus the reality of physical supply. On a typical trading day, derivatives markets facilitate transactions representing hundreds of millions of ounces of silver, often approaching or exceeding the total amount mined globally in an entire year. This ratio is not merely high, it is extreme. Paper silver includes futures contracts, options, swaps, and unallocated positions. These instruments are designed to provide liquidity, hedging, and price discovery. In theory, they function as efficient intermediaries between producers, consumers, and investors. In practice, they have become the dominant mechanism through which silver is priced, largely detached from the physical market. This detachment matters because paper contracts do not require immediate delivery. Most are settled in cash, rolled forward, or offset before expiration. As a result, vast quantities of silver can trade hands without a single ounce changing physical custody. This creates the illusion of abundance. The physical market tells a different story. Annual mine supply is limited, recycling flows are constrained, and much of the above-ground inventory is either already spoken for or embedded in products. Unlike financial assets, silver cannot be conjured through leverage alone. It must be extracted, refined, transported, and stored. The disparity between paper volume and physical availability introduces systemic risk. As long as confidence remains high and delivery demands remain low, the system functions. But confidence is not static. It erodes under stress, especially when multiple participants seek physical settlement simultaneously. Historically, the silver market has experienced episodes where paper leverage overwhelmed physical reality. These moments are often dismissed after the fact as anomalies. Yet they reveal a fundamental truth. Paper markets rely on the assumption that most participants will not demand delivery at the same time. When that assumption is tested, price becomes the adjustment mechanism. The dominance of paper silver also shapes investor psychology. Price movements driven by algorithmic trading, options expiries, or positioning shifts can obscure underlying supply trends. This can lull participants into complacency, delaying recognition of genuine scarcity until it becomes unavoidable. Importantly, this imbalance is not accidental. It is the product of decades of financialization, regulatory design, and institutional incentives. Paper markets provide liquidity and profit opportunities for intermediaries. Physical markets impose constraints. As awareness of this imbalance grows, behavior begins to change. Industrial users seek direct supply agreements. Investors favor allocated metal. Large buyers withdraw material from circulation. Each of these actions reduces the float available to support paper claims. The result is a feedback loop. As physical supply tightens, paper leverage becomes riskier. As paper leverage becomes riskier, participants demand higher prices to compensate. Eventually, the price must reconcile the two worlds. Silver's vulnerability lies not in manipulation narratives, but in arithmetic. There is only so much metal. And paper claims cannot all be satisfied at current prices if delivery becomes the priority. 4. Physical market tightening indicators. One of the most reliable ways to assess stress in a commodity market is to observe indicators that reflect physical availability rather than financial positioning. In silver, several such indicators have begun to align in a manner that suggests tightening conditions. Chief among these indicators are lease rates. A lease rate represents the cost to borrow physical silver for a specified period. When supply is abundant, lease rates remain low or even negligible. When supply tightens, lease rates rise as lenders demand compensation for parting with scarce material. Recent movements in silver lease rates have been notable, not only for their magnitude but for their persistence. Spikes followed by partial retracements suggest a market probing its limits rather than experiencing a one-off disruption. Importantly, silver lease rates have diverged from those of gold, indicating metal-specific dynamics rather than a generalized precious metals trend. Another indicator lies in vault inventories, particularly within major clearing hubs. While headline inventory figures may appear stable, closer inspection often reveals that a significant portion of reported metal is encumbered, pledged, leased, or otherwise unavailable for delivery. What matters is not gross inventory but free float. As physical demand rises, this free float shrinks. Industrial users, mints, and large investors remove metal from circulation, reducing the pool available to support paper markets. This process is incremental but cumulative. Delivery times and premiums offer additional clues. When buyers are willing to pay above spot for guaranteed delivery or accept delays as unavoidable, it reflects strain. These signals often emerge before price responds meaningfully. Taken together, rising lease rates, constrained inventories, and altered procurement behavior paint a picture of a market under pressure. These are not speculative indicators. They are operationals. Silver's physical market does not tighten uniformly. Stress may appear in specific regions, forms, or timeframes. But once established, it tends to spread. Arbitrage mechanisms that normally smooth disparities rely on availability. When availability falters, frictions grow. The key point is that physical tightening does not require a crisis to matter. It merely needs to persist long enough to undermine assumptions. Markets price expectations, not absolutes. When expectations shift from abundance to uncertainty, prices adjust accordingly. 5. Industrial demand and strategic procurement. Silver's industrial demand profile is undergoing a subtle but important transformation. For decades, industrial usage was treated as a stable background variable, predictable, incremental, and largely price-insensitive. That assumption is becoming outdated. Modern electronics, renewable energy systems, advanced medical devices, and next-generation batteries all rely on silver's unique properties. Conductivity, reflectivity, antimicrobial behavior, and thermal performance make it difficult to substitute at scale without compromising efficiency. As technologies evolve, silver intensity per unit may fluctuate, but aggregate demand continues to grow. More importantly, the consequences of supply disruption have become more severe. A shortage of silver can halt production lines, delay product launches, and erode competitive advantage. This reality is driving a shift in procurement strategy. Rather than relying solely on spot markets, industrial users are increasingly seeking long-term supply agreements, prepaid offtake contracts, and direct relationships with miners. These arrangements prioritize certainty over price optimization. Such behavior is revealing. When end users move upstream to secure supply, it signals concern, not about today's price but about tomorrow's availability. This mirrors behavior seen in other critical materials markets, where strategic importance outweighs cost considerations. In silver, these strategies have disproportionate impact. Each ounce locked into a long-term contract is an ounce removed from the open market. The effect compounds as more participants adopt similar approaches. Unlike speculative demand, industrial demand is sticky. Once supply chains are configured, they are not easily unwound. This creates a floor beneath physical demand, even during economic slowdowns. Furthermore, industrial demand competes directly with investment demand for the same physical metal. Unlike gold, where central banks and investors dominate, silver's industrial consumers are price takers by necessity. They must secure metal regardless of market conditions. As strategic procurement accelerates, it constrains flexibility. The market loses its buffer. When shocks occur, geopolitical, logistical, or financial, there is less slack to absorb them. This dynamic reinforces silver's asymmetric risk profile. Upside pressure can build quietly, then release suddenly when constraints bind. Downside pressure, by contrast, is cushioned by non-discretionary demand. Large-scale physical accumulation. Beyond industrial users, another source of pressure on the silver market comes from large-scale physical accumulation by wealthy individuals, family offices, and non-traditional investors. Unlike retail demand, which is fragmented and price-sensitive, these actors operate with longer time horizons and greater tolerance for illiquidity. What distinguishes recent accumulation patterns is their emphasis on physical ownership rather than paper exposure. Large buyers are increasingly opting for allocated metal, often stored outside the traditional banking system. This choice reflects a desire to eliminate counterparty risk. Historically, attempts to influence the silver market through leveraged futures positions ended poorly. Modern accumulators appear to have learned from these episodes. Physical ownership does not require margin, cannot be liquidated by exchanges, and does not depend on contractual performance. When significant quantities of silver are removed from circulation in this manner, the impact is structural. Unlike speculative positions, physical hoards are rarely returned to the market quickly. They function as long-term sinks. The silver market's small size magnifies this effect. Tens of millions of ounces may sound large in absolute terms, but relative to global financial flows, they are modest. Yet in silver, they represent meaningful shares of available supply. Accumulation also changes psychology. When prominent buyers commit capital visibly, it attracts attention and validation. Other participants reassess assumptions, accelerating demand. Importantly, this behavior is not driven by short-term price expectations. It is driven by macro uncertainty, currency concerns, and distrust of financial intermediaries. These motivations tend to persist. As more capital seeks refuge in tangible assets, silver benefits from its accessibility relative to gold. Large buyers can acquire significant exposure without moving into markets that are heavily monitored or politically sensitive. This accumulation does not need to be coordinated to be effective. It merely needs to continue. 7. Market awareness and narrative shift. Markets do not move solely on fundamentals. They move on perception, attention, and narrative. Silver's story has long existed on the fringes of mainstream finance, dismissed as either too small or too volatile to matter. That perception is changing. Mentions of silver across financial media, social platforms, and investor commentary have increased. While still modest compared to equities or cryptocurrencies, the direction is notable. Awareness is expanding beyond niche communities. Narrative shifts often begin quietly. Early adopters focus on mechanics, supply-demand structure. As evidence accumulates, the story becomes easier to tell. Eventually, it reaches a tipping point where attention itself becomes a driver. Silver's narrative is particularly potent because it intersects with broader themes: inflation, energy transition, technological dependency, and financial stability. It is not a one-dimensional story. As awareness grows, new participants enter the market, often unprepared for its characteristics. This can amplify volatility. Thin markets react sharply to inflows. Importantly, narrative shifts are asymmetric. They build slowly and unwind quickly. Once silver captures broader attention, it does not require universal agreement to move. Marginal buyers are sufficient. This is why silver's small size is a feature, not a flaw. It allows narrative-driven flows to have real impact. Forward outlook: repricing risk in silver. Looking ahead into 2026, the silver market appears increasingly exposed to repricing risk. This does not imply inevitability, nor does it prescribe timing. It reflects the convergence of structural pressures that reduce the margin for error. Paper markets continue to dominate price discovery, but their foundation rests on assumptions about availability and behavior. As physical tightening persists, these assumptions weaken. Industrial demand is becoming more strategic. Physical accumulation is becoming more deliberate. Awareness is spreading. None of these trends reverse easily. Repricing events rarely announce themselves. They occur when stress exceeds tolerance. In silver, that threshold may be lower than many expect. Whether adjustment comes gradually through higher prices or abruptly through dislocation remains uncertain. What is clear is that silver is no longer a passive asset. It is active, contested, and increasingly constrained. Markets eventually reconcile narratives with reality. In silver, that reconciliation may be approaching.